Hello, and welcome to the updated Introduction to Compensated Absences for Cash Basis Governments. My name is Christy Kogel. I'm an Assistant Audit Manager with the Local Government Support Team at the Auditor's Office. Since this is an introduction, we are just going to do an overview of the standard and how that applies to governments here in Washington. And we'll go over some examples, including sample calculations. Let's start by defining compensated absences. A compensated absence is leave that meets any of these three criteria. Leave that employees can receive cash payments when the leave is used for time off. So that's like normal usage of leave. I used leave on Monday and did not work, but still got paid. Receiving cash outs for unused leave at termination. So that's like getting a big payment at retirement for unused leave. Non-cash settlements. This would be like instead of getting a cash out, the leave gets converted into another benefit. An example is having your leave cash out put into a VIBA account. So now we know the definition of a compensated absence, but what actually goes into the calculation of the compensated absence liability? You have a liability when there is leave that has not been used and it meets all three of these criteria. It is attributable to services already rendered, as in the employee already earned it. The leave has to accumulate, so if they earn 8 hours a month and don't use it, they start to stack up a balance of unused leave. This accumulation must cross over fiscal year end. So if you have a use it or lose it policy, that does not count towards your compensated absence liability. The final criteria is that there is a 50% or more likelihood that the leave will either be paid in cash or settled through non-cash means. That your cash outs are like giving a lump sum to the employee or putting it in their VIBA account, or there is a 50% or more chance that the leave will be used for time off. This is a change from before. Most people were only recognizing a liability for amounts that could be cashed out by the employees. Now, though, you also have a liability for leave that will be used up. In addition to leave that has not been used, you also need to look at leave that has been used but not paid yet. So that's like if someone takes a vacation the last week of December and you don't pay them until January. As a cash government that doesn't report a wages payable liability to SAO, you must include this in your compensated absence liability. When calculating the compensated absence liability, you use the pay rate that was effective at the fiscal year end, unless there is a 50% or more chance that you will actually pay it out at another rate. An example of that is if your policy says you only cash out leave at 25% of the employee's pay rate, then you would use that 25% of the pay rate. You also need to include salary-related payments in your liability calculation. How do you know if leave is 50% or more likely to be used or paid? It involves professional judgment and estimates. We recommend starting by reviewing your policy. What does it say? Who gets to cash out leave and when? How is leave accrued? Do you have any caps on how much can be accrued? Is leave cashed out at 100% or a lesser amount like 25%? It's important to know your policy because that can affect the liability calculation. We'll take a look at a couple examples in a few minutes that demonstrate how your policy could affect the calculation. When looking at employee leave, evaluate if it will be eligible for cash out or to be used. To help determine whether it's 50% or more likely that it will be paid, look at your historical information. How much leave is typically used versus cash out? You don't have to do an individual analysis for every single employee. You can create groups of employees separated by similar characteristics and evaluate the historical information for the group as a whole. For example, if you have some employees that are in a union and they all have similar leave benefits, it may be logical to evaluate the historical leave trends of the union employees as a whole. If you have part-time or seasonal employees that earn leave at different rates from full-time employees, maybe they are their own group. You really need to look at the categories of employees at your government for this analysis and make groups that make sense for your government. There is no one size fits all. When reviewing those historical trends, the purpose is to use that past leave history to predict future leave usage and cash outs. So just be alert for any items that would indicate the historical information was unusual and may not correlate to future trends or patterns. We recommend going back 5 years. That way, if there is an anomaly in 1 year, you have extra data you can look at. But this estimate will involve some professional judgment. Salary-related payments include payments that are directly and incrementally related to the leave. That means the government must make the payment in addition to the salary or wages, and that payment amount depends on the salary or wages paid. This includes payroll taxes like Social Security tax and Medicare taxes. The government is required to pay that in addition to the salary, and the amount of taxes depends on the amount of salary paid. It could also include amounts that must be paid to a health savings account, flexible spending account, or a defined contribution pension and OPEB plan. Notice that I said defined contribution plan. That means we are going to exclude payments that must be made to the state-sponsored DRS plans like PERS, PERSERS, and LEF, since those are defined benefit plans. So it's important to know what pension and OPEB plans your employees participate in. One thing I do want to remind everyone on is that the salary-related payments are for the employer portion of those payments. So the employee's portion would not be included in your liability calculation. As with most new accounting standards, we have some exceptions. There are certain types of leave for which you will not recognize a liability until the leave has actually started. This is for leave that is dependent upon occurrence of a sporadic event that affects a relatively small portion of your employees. That includes things like military leave, bereavement, jury duty, and parental leave. You do not recognize a liability for these until an employee actually starts using the leave. For example, let's say you have a policy that allows 5 days bereavement leave in the event of a family member's death. If one person started bereavement leave on December 31st, then you would have a liability for the 4 remaining days they are allowed to use bereavement leave. For parental leave, You only have a liability if your government sponsors their own parental leave program. If your employees just use the state paid family medical leave, also known as PFMLA, then you do not have a liability because it's the state, not you, paying for those benefits. As a reminder, sick leave does not fall into this exception. Let's look at our first example. Since vacation and sick leave are the most common types of leave, we'll use these for some examples of how to calculate the compensated absence liability. In this example, we have a city that offers vacation and sick leave. For vacation leave, if they don't use all of it, 100% of it can be cashed out at termination or retirement. On the other hand, sick leave is only cashed out when they retire or die, and they're only allowed to cash out 25% of their accrued hours. The wording in your policies is important here. For vacation leave, they get to cash out at termination. Every employee will terminate at some point, so every employee has a chance to cash out some vacation. On the other hand, for sick leave, it's only cashed out at retirement or death. Not all your employees will retire or die while employed with you, so it's a smaller number of employees that will be cashing out sick leave. Let's look at how these policies impact our liability calculation. Our city has 3 employees. First employee has a pay rate at the end of the year of $25 per hour. They have accrued 60 vacation hours and 100 sick hours. Employee number 2 is paid $50 per hour with 100 vacation hours and 300 sick hours. Employee number 3 is paid $30 per hour with 80 vacation hours and 250 sick hours. Now, when we calculated the compensated absence liability, we are only considering the hours earned as of fiscal year end. We do not estimate future accruals that the employee might earn. Remember, our liability only includes leave that has not been used and is attributable to services already rendered. Future accruals are attributable to future services the employee will perform, so only use the hours accrued as of fiscal year end. Let's start with vacation leave first. From our policy, we know that 100% of the leave is allowed to be cashed out. That means regardless of whether the employee uses or cashes out the leave, the city will pay all of that vacation leave balance. That means we are going to include 100% of each employee's vacation hours in our calculation. Then we multiply that by their pay rate as of the fiscal year end, and we need to include those salary-related payments. But remember to not include any contributions that will be made to DRS pensions. Here's what the calculation looks like. We start with their pay rate and multiply it by their total vacation hours. Then we add salary-related payments. In this example, they only have FICA taxes, which are the Social Security and Medicare taxes, totaling 7.65%. For all employees, that gives us a total liability of $9,582 for unused vacation leave. This one is pretty straightforward, but let's take a look at the sick leave now. The sick leave calculation is broken up into 2 components: how much leave will be used and how much will be cashed out. We will start with how much will be used. Any leave that was already used or that is expected to be used is paid out at 100% of the employee's pay rate. That makes sense, right? because if you take Tuesday off for a doctor's appointment, you expect to get paid at 100% of your normal rate, unless your policy says otherwise. Now, how do you determine how much leave is expected to be used? You have to estimate it. This is where the historical trends come in. How much of their accrued sick leave do employees typically use? After you estimate total sick leave to be used, you multiply it by the pay rate as of the end of the fiscal year. Remember to include those salary-related payments, but not the DRS contributions. Here's what that calculation would look like. We have the pay rate and total sick leave hours from the original table, and now we add a column for how much leave is estimated to be used. In this example, I estimated that the employees will use 75% of their balance based on past trends. Next, we take the hours estimated to be used and multiply it by the pay rate. Add salary related payments and you get your total. So for sick leave expected to be used, we have $7,186. We aren't done yet, because there's a possibility some of our employees will also cash out their leave when they retire or die. To calculate this portion, we start with total accrued sick leave and subtract out the amount expected to be used, because we already calculated a liability for that. Next step is to consider what employees might retire. For this, you can look to employment trends. How often are people moving jobs? You could also consider vesting periods. People not vested may be less likely to stay and retire. Remember earlier I said you could group employees for analysis. This also comes in handy during this estimate. For example, if you had some union employees that you grouped together for determining trends of how much leave they are likely to use, you have to maintain that same grouping to determine how likely they are to retire. Let's say the union has awesome retirement benefits, so employees are highly motivated to stay and retire from your government. Then you'd probably count those folks in group of more likely than not to retire. Again, our threshold here is 50% or more likely. So if the group has a likelihood of more than 50% for retiring, include them in the cash out calculation. On the other hand, if you have a bunch of part-time seasonal employees, the likelihood of them retiring and cashing out sick leave is very low. So you would not include those folks. Again, this is an estimate and takes professional judgment. Document your rationale for your judgment calls. We take the remaining sick leave hours and multiply it by 25% because our policy said they are only allowed to cash out 25% of their sick leave balance. So this is why it's important to know your policy. Again, we use the pay rate as of the fiscal year end and include salary related payments, but not DRS pension plan contributions. Here's what that looks like. We have the pay rate and total sick hours from our first slide. Now we subtract out those hours estimated to be used. We put that calculation in the remaining column. Now we determine who is likely to retire. In our example, employee number 1 is not likely to retire, so the estimated hours to be cashed out are 0. The other employees are more than 50% likely to retire, so their remaining sick leave is estimated to be cashed out. Then we multiply hours estimated to be cashed out by 25%, since they are only allowed to cash out 25%, multiply that by the pay rate, and add salary-related payments. That gives us a total liability of $498 for sick leave to be cashed out. But we aren't quite done. The last step is to add all of these calculations together to get your total compensated absence liability. So we take vacation leave, sick leave expected to be used, and sick leave to be cashed out, and get a total liability of $17,266. I have one more example to walk you through. This time we are only going to look at sick leave. In this case, unused sick leave can be cashed out at termination. Remember, everyone terminates, so everyone is potentially able to cash out hours, but they only get paid 25% of their pay rate, and they can only cash out up to 240 hours. We have 3 employees. First one has a pay rate of $25 with 600 hours. Second has a pay rate of $50 with 800 hours. And third has a pay rate of $30 with 700 hours. Again, we split sick leave into used, are expected to be used, and cashed out hours since those calculations are different. We start with hours expected to be used. This part should look familiar because it's the same process as our last example. Sick leave to be used will be paid at 100% of the pay rate. We start by estimating how many hours the employees will use. Remember to include salary related payments, but not DRS contributions. We start with the pay rate and total sick hours for each employee. Now we estimate how many hours they will use. At this city, experience and historical trends tells them employees typically use 65% of their leave, so the estimated to be used column is 65% of the total sick hours. Again, this is paid out at the full rate because it's time they are actually going to use while they are employed. Then we add in salary-related payments like FICA tax, and that gives us a total of $53,179. Now we move on to step 2. What about the leave that will be cashed out? We start with the total accrued leave and subtract out the hours estimated to be used, since we already included those in our liability calculation on the previous slide. Remember, they can only cash out up to 240 hours, so we have to cap the hours if anyone has more than that. And this time the leave is paid at 25% of the pay rate. Let's look at what that looks like. When we subtract out the hours estimated to be used from the total sick hours, that gives us 210 hours for employee 1, 280 hours for employee 2, and 245 hours for employee 3. But remember, our policy told us they are only allowed to cash out 240 hours, so I added a column for hours allowed. Then first employee gets to carry over all their hours since it's under the cap. And employees 2 and 3 only get 240 hours each. Again, see how your policy can affect the calculations. Next, we multiply the pay rate by 25% because the policy says they use 25% of the pay rate for cashed out sick leave. We take the 25% cash out rate and multiply it by the total hours allowed to be cashed out, add our salary related payments, and you get a total sick leave to be cashed out of $6,581. The final step is to add it all together. The sick leave expected to be used is $53,179, and the sick leave to be cashed out is $6,581 for a total sick leave compensated absence liability of $59,760. Now that we have our liability numbers, what do we do with them? For the Schedule 09, we will use the liability code 25912, which is not a change, but now you can net the increases and decreases when reporting. When implementing this change on the Schedule 09, the beginning balances will not be restated. That means take the ending balance from fiscal year 2023 and then use the calculation for your government as the ending balance. The difference between the ending balance and beginning would be either the increase or decrease. If you present notes to your financial statements, the compensated absence liability will be reported in Note X, long-term liabilities, which was formerly long-term debt, and the compensated absences policy will be added to Note 1, summary of significant accounting policies. We have now come to the end of our updated introduction to compensated absences. If you have any specific questions, please use the contact information on the screen and we can assist you in working through the implementation. Again, thank you for taking the time with me today to learn about compensated absences.